This week, I'm going to look at the power of boring investing and the case for dividend growth stocks. Now, it seems to me that for most, even new, and a lot of old investors, they want excitement in the market. Well, fortunately for them, meme stocks are back. Does anybody know where this came from? Anybody?
Twitter. Just kidding.
True Detective. It's from True Detective. It's
okay.
the first season, the best season. Watch it. All right, that's all I'll do. So memes are back, as you can see there, and so are SPACs, and the return of the SPAC king, Chamath. I'm gonna bastardize his last name if I say it, so I'm not gonna say it. Who built a large public following through social media and media appearances, where he promoted these companies with great enthusiasm. He was seen by many as a champion of the retail investor, not so much. When the stocks collapsed, his response famously telling investors, "There's no crying in the casinos." This was perceived as dismissive and insensitive, pretty much is. Many investors felt he used his platform to hype speculative and money-losing companies, then walked away with his profits while they suffered the losses. Now, Chamath backed not today's, but his past Chamath backed or involved specs included Virgin Galactic, down 95%, Open Door, down 95%, Clover Health, the big winner here, down 90%, and both Proterra and Sun Life Financial, which filed both for bankruptcy. But he's SPAC. Chamath, after a period of relative quiet in the SPAC market, has launched a new SPAC called American Exceptionalism Acquisition Corp. A. Here's a breakdown of the SPAC, a new $250 million SPAC that filed for an IPO. It'll file this week, I believe. It plans to trade on the New York Stock Exchange under a ticker symbol that I'm not aware of, but might as well just be called SPAC crap. This SPAC focuses on companies in areas that Chamath believes are critical for American leadership. We might agree with this, but it's artificial intelligence, decentralized finance or DeFi, defense technologies, and energy production. And history is probably set to repeat itself. Now, in the fun times, Robinhood, the upstart online brokerage, even managed to turn investing into a video game with mysterious rewards and digital confetti to celebrate your trades. When it's fun, it's fun until it's not. The music stops, your seat is removed, prices fall, and that fun turns into regret. Recall the NFT craze in 2021. People were paying millions of dollars for images of lazy-looking, disenfranchised apes. Since then, Bored Ape Yacht Club NFTs have crashed 90% from their all-time highs to levels seen before the NFT hype boom began in 2021. And the entire market is much less active for NFTs. Robinhood, of course, got fined for that digital confetti. And yet boring investors, not boring apes, keep winning without ups and downs. Take Warren Buffett. His best investments aren't new tech or AI. They're Coca-Cola, railroads, credit cards, and Apple, which he brought Apple after the iPhone came out. Apple was not considered exciting then at all. He makes nearly $4.5 billion in dividends every single year, whether the market goes up or down. That is the power of dividend growth investing. It's not exciting, but it works. Now, let me give you a couple of examples from our research. We see here from Keystone's Canadian Dividend Growth Stock Research, Brookfield Infrastructure, recommended in March 2011 at $9.91. As of August, the end of early September, it has paid approximately $25.86 in dividends per unit. Again, recommended at $9.91. It's paid us $25.86 in dividends, resulting in a total return of 594%. From our Canadian small cap growth stock research, another dividend grower that has produced both astonishing dividend and price appreciation in a short period of time, 5 years. That company, Hammond Power Solutions, HPS.A on the TSX, recommended as a buy, $6 in March of 2020. As of early September, Hammond Power has paid $3.69 in dividends per share, and the dividend has increased approximately 223.5% from March 2020 to March till this year. This has increased. This has resulted in a total return of 1,930%. Companies like Johnson & Johnson, Procter & Gamble, Chevron, these companies won't double next month, but they paid and increased their dividends for decades. Every 3 months, they pay you. And every year, they increase that payment. Small steps, but over time, they compound into freedom. Exciting investing is expensive. Buffett recently wrote, for whatever reasons, markets now exhibit far more casino-like behavior than they did when I was young. The casino now resides in many homes and daily tempts the occupants. Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. That came from Paul Samuelson. Samuelson knows that you pay for excitement in investing. And he's right. NFTs, crypto, meme stocks, most crashed. Dividend growth stocks just keep paying you. Boring is beautiful. Dividend investing doesn't just grow your wealth, it also protects your peace of mind. When the market crashes, you don't have to panic. You don't have to watch your portfolio or the news 24/7. You know those dividend checks are still coming because people will still buy toilet paper, Coke, gasoline, and groceries. You'll still need transformers in buildings, and they'll use credit cards to pay for all this. You can sleep at night. Boring works. So if your portfolio feels boring, you're probably doing something right. And there's our disclosures, Hammond Power and Brookfield Infrastructure.
Yeah. I guess that's something as well that I could have elaborated on that I'm looking forward to, presenting, is just looking at, the effective yield and dividend growth stocks and how powerful it can be in your portfolio. That's another segment that I did in the webinar here. And like Ryan touched on, I'm pretty sure on Warren Buffett's original investment in like 1970 that he made, I believe his effective yield on on Coca-Cola is now over 50%.
Yeah.
He's earning 50% a year on his initial investment every single year. And that will continue to grow as long as Coca-Cola continues to grow their dividend. It just shows
if you look
power.
At Hammond Power, the effective yield on that just since 2020, if you would have bought then, the effective yield is over 18%. Yep. So whether that stock goes up and down for our clients that are bought at that point in 2020, they're getting paid 18% plus a year. It has gone up, obviously, which is nice to see, but you start to get that yield and it's going to, we expect that dividend can grow again this year, right? It compounds on itself over time, which is great to see.
Yeah, as well. Like I'd also mentioned, just like on like the Bored Ape Yacht Club, I think like at the peak of that, I remember like Justin Bieber, I think it was like something upwards of $1 million he paid for this NFT. I think that, like that NFT, like don't quote me on this, but I think that NFT is worth like, $50,000 today or something like that. Destruction of capital. I remember
one of Bieber's best investments still.
One of Bieber's best investments.
Sad things.
I remember my cousin, during like 2021 when everybody and their dog was, getting a investing or a self-directed brokerage platform, and my cousin told me, "Hey, you got to check out this Virgin Galactic Space SPCE." It was then trading at a couple, $300 per share. I think it's trading at, $4 per share today. Again, fundamentals are like gravity. We talk about it all the time, but it's something that you need to focus on in your portfolio.
Yeah, those SPACs from Chamath were just this. He was involved in. This SPAC is supposed to be different. He doesn't, they vest over time the shares, but they got like founder shares or whatever you want to call them in those investments, and they just cashed out as they went higher. That was an opinion here, but it closer to white collar crime than anything else.
Business.
But I'm sure all the disclosures were there saying that your money's completely at risk, but it's fairly gross.
Yes, you're saying SPACs are back, but it's compared to the 2021 period.
Exactly.
So
They're not.
there was 84 SPACs so far this year that have IPO'd. How many do you think were in 2021?
Oh,
200?
400.
Higher. You got
7 million. No, okay.
a bit lower than that. Cameron might have won it that way.
1,000?
600.
600, yeah, 613.
Oh, nice. Okay.
So
I think because I was commenting on SPACs that I think that kind of starts to ring a bell. But crazy, yeah, they're not back. No,
yeah, and
definitely.
you could see them just start to. None of them could buy any private companies in the following years, so the SPAC funds
went back,
slowly drained out. They went back to the initial investors at that $10 a share price. Which that's why you always see. If you see these companies that are called Acquisition Corp, or it'll be like Biopharma 3 or something, those are SPACs, just so you are aware, because we will get occasional questions, what is this? They're almost always named in that manner. So if you do see something, it'll trade around $10 a share.
Yeah, looking like 10, to buy 10. A company is what they're doing.
Exactly. And all they're doing is looking to actually find something to buy. They have nothing of value past a pile of cash in them at the time. And normally, like Ryan has went through, they lose a lot of money. This is just pulling off the same website, SPAC Insider. The worst returning sector, minus 97.6% cannabis. Just gonna throw that one out there because I know that's something we've talked about before.